Welcome to the Investor Summit Green Room, the behind-the-scenes monthly podcast where we bring you informal one-to-one interviews, panel discussions and presentations with leading industry specialists, fund managers and financial journalists, which we hope lead you to make better investing decisions. Do please take note, the views expressed in the Investor Summit Green Room podcast are for information purposes only, and nothing in this podcast constitutes a financial promotion, investment advice, or indeed personal recommendation. Today we welcome Nick Brind, co-fund manager at Polar Capital Global Financials Trust and lead manager of the Financial Credit Fund. PCFT is a London-listed investment trust with a market cap of just under 400 million, focused on investments in the financial services sector, i.e. banks, asset managers, stock exchanges and online payment businesses. Nick.
Good morning. Thank you for having me.
It's a pleasure to have you on the Green Room sofa.
Thank you very much.
So let's jump straight in.
Yeah.
Financials. Where are we in the financial cycle? Tell us all.
Yeah. The financial sector hums with the economy and financial markets. So in that sense, actually, it's in a really good place. But the key thing is to remember that, for the financial sector greases the wheels of the global economy. So wherever we are, it's always important to know, how's it performing and is that an opportunity? And we think it is.
Yeah, you're seeing opportunities out there, are you, Nick?
Yes, always. Market volatility always creates some, interesting opportunities. Short-term sell-offs create opportunities and vice versa.
And my holistic overview question for you, what's the attraction of global financials, given that you've spent your career working in them?
Yeah, it's a really good question. And I think, you take a step back and just remember financials is the second largest sector globally after technology. So it's extremely important for anyone investing in markets or for asset allocators. And the interesting aspect of it is several fold, but we can touch on a few of those. One is it's always a fight off between financials and energy, which is the cheapest sector in the market. Its complexity as a function, in part because of what happened during the global financial crisis. You've got an alphabet soup of acronyms. Regulators, accountants have made this, much more difficult to understand. But that also, creates opportunities, for people who can put the work in and I suppose understand the underlying fundamentals.
So you trace everything back to 2008 and the financial crisis, and then the evolution since then, as some have performed better than others, would you think?
Yeah, if we had this conversation 5 or 6 years ago, just before the pandemic, you would have gone, why do I even need to, think about investing in the financial sector? Roll on the pandemic, and we've gone from a period of zero or negative interest rates to interest rates coming back to some sort of normalized level, whatever normalized level is. And that means banks, insurance companies, other financial services companies can make, better returns. When you think about a bank, what it receives in interest on your mortgage or a loan it's given to a business, to what it needs to pay out on deposits and savings. As interest rates have gone up, that margin has widened, and as we've seen, they're going back to making the kind of money they made back in the early 2000s, the 1990s, etc. But that improvement in profitability has created a great environment for, growth in profits and therefore shareholder returns.
So business is booming for the banks and insurance companies.
Business is booming for the banks. I suppose one quick factoid, because obviously it's all been about AI recently. If you take the last 5 years, you bought a portfolio of European banks, and they're up about 350%. The Mag 7, I think, I'm trying to remember, it's up about 250%. Even the semiconductor index, we all like NVIDIA, that's only up 200%. So despite all the sort of attention of the news, the media, investors, quietly under the hood, you've been able to make really good returns from parts of the financial sector.
If you'd had the courage to invest in them when they were at their lowest ebb and everybody was negative about the banks.
Yeah, but even then, I mean, this is 5 years ago, so we're thinking of 2021. I mean, the lowest ebb was probably in the middle of the pandemic when the lights got turned off the global economy and people assumed there'd be a huge spike in people defaulting, businesses defaulting on their loans. And from that period, returns have even been higher. But yeah, the recent past has been a great time. Even if you go back prior to that, financials probably were annualizing at about 9-10% per annum. So in an environment of low or negative interest rates for a sector that was very unloved, it actually been eking out some decent returns, and that's been supercharged in the last 5-6 years.
You can't knock 9 or 10%.
No, I would very happily go home with that.
I would very happily get that. Your largest holding is JP Morgan at 6.7% as of the 3rd of July. Portfolio was held 51.5% in banks. 47.5% geographic exposure is to North America.
Yeah.
So what's the rationale behind banks, North America, and tell us a little bit about how the US earnings season is going.
Yeah, I mean, it's been fantastic. I mean, ultimately, the financial sector is just a reflection of what's going on in financial markets and economies. So there's boom in financial markets, IPOs with SpaceX, etc., M&A activity, trading because of the volatility, as a result of what's happened in the Middle East. And last year, obviously, with tariffs, means the big banks have been making really good money. So you look at the big US banks like JP Morgan, Bank of America, their profits were up 20-30% year over year. If you go to the into the middle of the casino, then Goldman Sachs and Morgan Stanley, their profits are up more like 40% plus, especially in equities trading. So doing really, really well. And that's reflecting the strength of the US economy. So that's in a sense partly reflects why we have a big exposure to the US.
And let's explore your portfolio a little bit more.
Yes.
Your asset allocation, your number of stocks held, length of time you hold a stock. So it gives us a sense of the rhythm of how you actually run your portfolio with your co-fund managers.
Yes,
apologies to them.
Yes.
Have you all run the portfolio?
Yes. So the trust was originally launched in 2013 as a sort of low risk way to play the financial sector. And now going for 13 years, we can talk a bit about the structure in a minute. But ultimately, you can't escape. Financials is a value sector. So at heart, you have to be a value investor. But notwithstanding that, there's some great growth businesses within it. I mean, the payment businesses like MasterCard and Visa, really, effectively toll businesses, taking a clip every time you use your card in a shop or wherever. Very resilient, very profitable, growing nicely.
And you hold both Visa and MasterCard.
We do hold both Visa and MasterCard.
I noted that.
Yes. We've been adding to them recently on weakness. And you've got other growth businesses that, through different periods will do well. One of the themes we've played, sounds awful, this thing called democratization of investing. So there's some great statistics which we found the other day. And, the average age people started investing, if you're in your 60s, you probably started when you were about 35. And if you're a Gen X, then probably 20, I think it's 28 from memory. Millennials, it's 22, and then Gen Z or Gen Z, it's 18. The ability today to get your mobile phone and trade, whether it's crypto equities, you can short, you can go long, very different from what it was 10, 15, 20 years ago. And when you look at how much participation in equity markets you see in the US, it's something like 50% plus. In the UK, the figures are like 15%, I believe, and in Europe, it's like 7%. So you're seeing a huge growth in that. Now, that could be cyclical as well, but there's a big structural driver there. So we're trying to get a mix of some of these really interesting, cheap, solid businesses we like to own, as well as other sort of growth type businesses. So I suppose you'd describe us as sort of like, We have a blend of both, where we're trying to balance both that.
Balanced portfolio.
A balanced portfolio, yes.
But I think these things are just tags and labels at the end of the day. If you're not at one end of the spectrum and you're not at the other end of the spectrum, then essentially you're making money where you make money, you know. Using value where you can find the momentum, find the growth. It doesn't really matter what you'd label it, as long as you're finding it.
Yes, completely. I mean, and as we know, fads coming out of fashion, markets move in a direction they'll move too far. You've got to be conscious of that. And, hopefully if you with the foresight of profit, the agility of an acrobat, we can, move the portfolio around and take advantage of that.
Talking of fads, AI.
Yes.
Fundamental driver of the marketplace or fad? What do you think?
It's inescapable. I think it's a fundamental driver of markets. Now, time will tell as to how significant the impact will be on what businesses it will have an impact. We're seeing it in our sector. There's potentially some disruption there. People worry about things like stable coins or disruption for some of the sort of software or analytical services. Equally, on the cost side, is perhaps the most interesting for the financial sector. So I think it might have been I think it was a PwC, it was Accenture report that said the two biggest sectors that were likely to benefit most from efficiencies was banking and insurance. When you think about it, they are just businesses built on processing applications for loans, dealing with payments and so forth. And, we're starting to see some, quite credible use cases where costs have been reduced, significantly.
We're talking headcount being reduced here.
Potentially as well, headcount will be reduced. Mm-hmm. Now, I suppose some banks will obviously there was a comment recently from the Standard Chartered CEO about headcount reductions. Other banks might be more thoughtful. If you're freeing up the time of some of your salespeople or business development staff, then they've got more time to go out and try and generate leads, or you can bring more people into that from different parts of the business that were held down by admin.
Okay. Which takes us to, it's probably very inappropriate to talk to you about this, but we had Ian Lance from Temple Bar in here a couple of weeks ago, and of all things, he made 100% on two South Korean banks, which he held when they were deeply unloved, quality businesses, stable earnings, share price completely bombed, and no one interested in them. Yeah. Is that the kind of thing that you might be searching for as well?
Yeah, I mean, we strange enough, we do also own two Korean banks.
No.
One is we own one that Ian owns and a different one. And yes, they benefited from that. I mean, when we speak to UK investors and they go, God, UK banks, I mean, why are they so cheap? Well, if you think they're cheap, go and have a look at South Korea, or you can go and look at China as well. And so today, UK banks are probably trading, like some NatWest and Lloyds are probably on 8 to 9 times earnings. Korean banks are 7.5 times. Now, the interesting thing is you look at some of the other developed markets out there, Canada, Australia, Singapore, and you've got banks trading on sort of mid-teens type P multiples. So even today, despite the rally in bank shares, there's a lot of value in some of these banks.
And your mandate is wide enough that you can take in pretty much the world.
Yeah, so it's a global mandate. Yes, we're biased towards the US, but we have a big, exposure to Europe and elsewhere. And so we have exposure to Canadian, Singapore banks, Australian no at the moment. I'm in the pot at the end of the rainbow of gold is Commonwealth Bank of Australia that trades on 25 times earnings. So banks are seen as, quite sometimes often dull, stodgy, albeit hopefully boring businesses that pay a good dividend yield and grow a bit every year. But there's been some really interesting banks out there, and people are happy to pay up for that.
What sort of things have you been picking up recently? What are the bargains that you've been spotting? Because I think that's of real interest to the audience.
Yeah. So I mean, very short term, and we haven't done a lot on the portfolio, but very short term, conscious that maybe the sort of momentum AI trade had perhaps gone over the front of its skis and extended a bit. So we started adding to some of the stocks in the sector, which had been, I suppose, on the opposite side of that trade. So we bought a new position in AJ Gallagher, which is a big global insurance broker.
We know them well. I know someone who works for Gallagher's.
There we go. Yeah, so the insurance brokers got here. Combination of worries about a softening outlook for the insurance market. As we all know, insurance premium rates have gone up a lot in recent years. So that's been rolling over. Some concern about AI disruption. Equally, we've been adding to MasterCard and Visa. A couple of worries there. Again, AI disruption, stable coins, regulation around credit card fees in the US. We thought that had been overplayed. So,
in terms of hard analytics, 1 year performance and 5 year performance, whatever performance you're most comfortable
so
giving me.
Just to quickly explain the structure of the trust, and then I'll hopefully put performance in context of why I've used a certain period. The trust was originally launched with a finite life to April 2020, which, as we know, with hindsight, was the pandemic. So it wasn't a particularly good choice of timing to look at rolling over the vehicle. Nevertheless, we had very strong support from shareholders. The vehicle's life was extended indefinitely, subject to us giving 100% tender at NAV, that's a little bit for cost, every 5 years. So we did one last year in June, so a year ago. We did one back in April 2020. And that means you've got a certainty. One of the issues, as you appreciate, with investment trusts is they're quite volatile around the discount at which they trade relative to their NAV. And so people knowing that at some point in 2, 3, 4, 5 years, they could get their money back at NAV, helps keep the discount narrow. We buy back shares as well. So with that in the context, so over 1 year, off the top of my head, we've done about, I think I've written it down here, sort of 20% versus 18% against the benchmark. So 20%.
What's your benchmark?
So the MSCI ACWI, All Country World Index Financials. So global.
Is that a challenging index?
Yes, I'd say in the last 10, 12 years, was the US outperforming everything. That's been, I think, for most investors, unless they're very growth orientated, been challenging. So we were about 2% ahead over a year. If you go back to the tender in 2020, then you're looking at sort of more like 189 versus 181% return. We gave back a bit of that, so over 5 years, we're probably a little bit behind. So you've been getting mid-teens plus kind of return from owning the trust over the last 5, 6 years.
Yes, and you're trading it just below NAV, is that right?
Yes.
And where have you been historically with NAV? I mean, is that a narrowing?
Yeah, so pre the tender we did last year in June, it had probably traded from, I think when we first came to market, we got up to a 8-10% premium briefly, as wide as a sort of 10-12 discount. The board put in place a stronger buyback policy last June, the last tender. Since then, we've traded no wider than a sort of 5-6% discount. And at the moment, we're at about 3 to 4.
You've got a decent yield, though. You've got a yield that's about almost 4%.
Yeah,
not to be sniffed at.
Not to be sniffed at. Everybody likes a little bit of income.
They do indeed.
Again, another change. We had a progressive dividend policy last year. It was moved to paying a 4% dividend, 1% paid per 1% of NAV paid every quarter. So we think that's also an attractive, makes a vehicle, attractive proposition.
And what are the buy catalysts we can look forward to?
So I think that ultimately, we'd always argue it's thinking about diversification, with financials being 15% plus of global equity markets, and a lot of the focus in the last few years has all been about AI, semiconductors, and tech. The benefits of having that diversification and just the compounding effect of good businesses making good returns. So that's taking a medium term. In the shorter term, as we've seen in the last couple of weeks, any rotation out of AI or tech tends to benefit financials and also healthcare as the other third largest sector in the market. But AI, if it succeeds, then some of these businesses will generate materially better profitability. Now, in the very long run, that's all got to be competed away. There's a brilliant chart that someone once showed me of 100 years of cost-income ratios of banking. So you think the old banking halls of the 1910s, 1920s, and uniform footman and huge ceilings, and the cost-income ratio was the same then as it is today for a bank. So at some point, any benefit gets competed away, but next few years could be really material.
Okay. We've endured in the short term Trump tariffs, US war in the Middle East, which is continuing, it would appear. We've had 10 days, 11 days of bombing of Iran. That looks like a war, not a ceasefire to me. Talk me through the benefits to the portfolio of all this volatility and disruption.
So the volatility tends to lead to more trading. People want to change their positioning. They want to hedge, whether they're commodity business or whatever, or they want to hedge some of their market risk in equity markets. That creates more business for banks and exchanges and brokerages. And then obviously the impact, not just from what's happened in the Middle East, but from the supply chains, from just in time to just in case, the need to invest in defense, from spending on electrification, AI, from obviously thinking about the environment and so forth. To us, that's an environment where interest rates are going to stay higher for longer. And if that's the case, that's great for the sector, because it means they're going to continue to generate good returns, and that feeds through to shareholders.
That's a compelling case you're making there, actually. That's very good. Okay. You've been in the industry how many years?
Over 30.
Over 30. So that's a lot of experience, Nick.
Yeah.
What have you learned in your 30 years? And what advice would you give retail investors?
Yeah, I mean, how much time do we have? I think probably the simplest, keep it simple.
Mm-hmm.
Don't invest in things you don't understand. Because if it goes wrong, then you think, well, what was I investing in this for the first place? And then the second thing would be, we look at I like looking at charts. Charts tell you a lot. A picture, tells you 1,000 words. And when a stock is going down, there's a reason for it. And if you don't know the reason, probably shouldn't be owning the stock, because someone does know there's something wrong with that business. So a couple of thoughts of that.
Couple of thoughts. How did you get into fund management? 30 years in the industry. How did you get into the industry? And are you happy to have spent the last 30 years doing what you do?
Yeah, it's so interesting. It's so stimulating. There's obviously, that's the fun part. The difficult part is then translating that into good performance, good returns for people who've trusted their money with you. And my tale is slightly odd in the sense I was turned down for an office junior role and got a job in a stockbrokers. And I applied to a fund management company, and I was told a few years later the reason I got the job was because I was married. Because they thought I was less likely to up sticks and leave. Anyway, I don't know how true that was, but it was,
Did you up sticks and leave?
No, I
You stuck it out, did you?
I stuck it out.
I see, they were right.
Yes.
Very good.
I lost my hair.
My final question, Nick, here we go. What's your outlook for the second half of 2026, the remainder of 2026, and then into 2027? What do you think is going to happen? Look into your
into our crystal ball.
Crystal ball for us.
Yeah, I mean, my crystal ball's no better than anybody else's. I think actually a lot can pivot on what's happening in the Middle East. The memorandum of misunderstanding, or whatever it's since been renamed. The economy, we've got away so far with oil prices, commodity prices being rising to a level which would inhibit, growth. If that's the case, and some solution or kicking of the ball down the road continues, then I think we're pretty constructive on the outlook. This spending that's going into AI, that's driving growth globally. Even in the UK, you're seeing corporate loan growth. UK banks is like 9% over the last year. So whatever your political leanings or concerns about Andy Berman or what they're going to do, the incoming Labour government, actually the underlying picture is showing quite some resilience, notwithstanding the externalities. So we're feeling pretty constructive. Having said that, markets aren't cheap, as we probably all know, and you just want to think about having some diversification, I think, and just spreading that risk. And
what to avoid? What should we avoid?
Well, I think, hype, obviously. We've seen the sort of drawdown recently in the last few weeks. Now, maybe we're still in a multi-year cycle of AI capex. That's still, so, there's perhaps that can pick up steam. But, there's echoes of what happened in 1999, 2000. Maybe we're not there yet, but, margin debt has gone up a lot. Got a lot more companies coming to the market with limited history of profitability or revenues. Every boom bubble is driven by some new technology. We're in the fun part at the moment, and that can probably continue for further. But just keep your feet on the ground.
Nick Brind, co-fund manager at Polo Capital Financials Trust. Thank you very much indeed for your words of wisdom there. It has been a real pleasure speaking to you on the Investor Summit Green Room podcast. And here I am again on the Green Room sofa with Sam Bell, CEO at Copia and the Investor Summit co-founder. Sam's an experienced private investor, and I'm learning the hard way. We're here to discuss the big investor moments of the week, none of which is investment advice, of course. Greetings, Sam. How are you this week?
Very well, very well. Interesting times as always.
As always. So we had Nick Brind on the Green Room sofa this week, and it was great to have his wisdom. 30 years of global financials.
Yeah, and not something I can say I pay a lot of attention to, but after listening to that, maybe some research is needed.
Likewise, but to hear him say it's the heartbeat of the global economy, and he proved the case.
Good proxy for the global economy.
Good proxy for the global economy. Made a lot of sense.
Yeah, absolutely.
Yes. And what out of what he was talking about, what was of interest?
That same theme from the Ian Lance one of a couple of weeks ago about these Korean banks. Korea is an interesting place to be investing at the moment. They had I think they've had rolling margin calls for most of their retail investors for the past week with their, what's the name of their index? I think KOSPI, K-O-S-P-I, where they had the problem there where, of course, there was this memory shortage, and so prices for memory were going up. And then two companies, I forget which, I think Samsung's one of them, but two companies ended up making half of their market, half of their index. So
overweight on a couple of big tech
retail
stocks.
were piling in over and over on margin, and it's all gone very, very wrong over the last few days. So hopefully the banks, however, are unaffected.
So it was very interesting to see that Nick is long JP Morgan, quite a significant chunk of his portfolio, 6.7%, and then 47.5% exposure to North America, 51% to banks, which, given that he's a global financials guy, is less surprising. But it's interesting. America's still where it's happening.
Yeah, and I think that goes for most sectors, doesn't it, really?
World's largest economy, and that's where all the deals have been done. That's the M&A. That's where the global trading is
still draining
place.
a lot of money from us. Of course, hundreds of millions have just gone to SpaceX from our UK investor community. So, still the way.
And presumably you weren't, in terms of the kind of week you had, you weren't actually catching up with England in the World Cup, were you?
No, you know me well. That's not my cup of tea.
I'm only teasing you. I had to ask you. I've been loving the World Cup. It was absolutely phenomenal, and even for a Scotsman, it was great to see England coming third. I thought they did really well. Thoroughly enjoyed watching them.
The Visit Argentina tourism guys are going to have a long road ahead of them to try and repair some of that.
They did not do themselves any favours.
No.
They were brutal, absolutely brutal, and behaved disgustingly. So that's what I think. Yes, Andy Burnham. If we're talking points of the week, then the talking point of the week, Andy Burnham is Prime Minister. Thoughts on that?
And well, it's as we record, it's day 2 of his premiership.
Yeah, day 2.
John Healey, not a bad choice. He was very conviction driven when he was. John Healey as Chancellor, of course.
Yes,
he was very conviction driven when he was in defence. But unfortunately, they've come out on day 2 and they're already making unfunded spending commitments. They're talking about reducing VAT on energy bills and saying we'll pay for it by scrapping the digital ID scheme, but that was never funded, which Darren Jones, one of their own MPs, has gleefully pointed out this morning.
Oh no, the digital scheme wasn't actually funded.
No. And if you're that keen to reduce energy bills, VAT is probably not the bit to worry about. How about, we get drilling in the North Sea in these Jackdaw and Rosebank fields. And
now, I'm going to take you to there. Yeah, it looks as though there's no major policy change going to take place there, which is disappointing. They're just tinkering around the edges.
Yeah, at some point, as happens with many governments, not just these guys, but the gilt market's going to start dictating some policy. So we'll see there. I think it's already... they're already dubious.
Bond markets are a proxy prime minister, after all.
Yeah, as Liz Truss found out very quickly.
She found out the hard way. SpaceX, it's fallen below its issue price.
Yeah, about 10% below IPO price as we speak. And what did it hit? 170 or something at one point.
Yes.
And now we're at 120, which is quite a fall.
But it's not surprising because they had such a market. The market forces, pretty much 20 different investment banks were supporting SpaceX. So
yeah, a lot of retail demand for it, but it does make you wonder where that demand's gone now. And then, of course, when you've got such a hype-driven sector, albeit one that over the long term could play out really, really nicely. It's dragging down your Filtronics, your Seraphim space, just from that connection with it, which is unfortunate. Otherwise, very well run trusts and companies.
So I'm in Seraphim, and I had a quick check before I come on here, and 23% down. But I'm not happy to be 23% down, but I do understand.
Yeah, it's one of these ones where the dust needs to settle and we'll see where it goes. Yeah,
I'm in for 5 years, and I realised I would be in for 5 years. So
nice thing for Seraphim as well. They've got a lot of dry powder to make some good investments when they do see bargains.
They've got 137 million that they've raised. Through retail book.
So they will have, they'll be out there looking for anything being marked down and to add to their trust, I would imagine.
So it's good for them. I'm glad. The Iran war continues. That, I'm afraid, is bad for the global economy and is bad for my portfolio.
Yeah, not good for our energy bills, of course, with oil and gas prices climbing. Not good if you want a holiday in Dubai either.
Not good if you're President Trump and you've got the midterm elections coming up in November.
Yeah, although the way they've gone about it, all this start-stop, we've got an agreement, we've not got an agreement, we've got an agreement again. No, that's off the table again. I think it's somewhat done on purpose just to create fatigue and eventually people stop looking at it. So
I think it's turned back into a war, though. 10 nights of bombing and the Iranians are escalating. So I'm worried.
But the last time this happened, we saw oil over $100. Now it's still in the 80s. So
I think you're hitting 90, but I take your point. Yes. Okay. Investor Summit. Do we have any news on the Investor Summit?
We've got a great lineup and it's full, and people emailing us every day and calling us every day to try and get on the billing. But unfortunately, we're completely full. But two brilliant openers, Shadow Chancellor Mel Stride would be a great one. And then
Lucy Castledine.
Yeah, I mean, hearing directly from the regulator, but specifically someone whose very job it is to, look at some of this red tape and try and make sure the FCA doesn't get in the way. I think that's a really nice story as well. So the two of those opening the day, I'm really looking forward to.
It's a very powerful start. But Lucy, it seems to be pro-change.
Yeah, and I think, this stuff comes top down as well. So it comes from Downing Street, the regulator, as distinct as they are, separate as they are, still gets lent on, I'm sure. And everyone wants to get Britain investing again. So that's going to be one of our key themes for the Investor Summit.
So come and join us on September the 18th.
Yes, please do.
And get
We've
Britain,
lined up great content. Please come and watch it.
Get Britain investing again.
Yeah.
Fantastic. That's it for now, Sam. Sadly, we're out of time. Great to catch up with you as always. Thanks as ever to everyone for watching, and do look out for our next podcast with Han ETF's Tom Bailey. Thank you very much indeed. Do please take note, the views expressed in the Investor Summit Green Room podcast are for information purposes only, and nothing in this podcast constitutes a financial promotion, investment advice, or indeed personal recommendation. This Investor Summit Green Room podcast is produced by Copia, creators of investor events, video, and websites. If you've enjoyed our monthly podcast, please do subscribe on YouTube or follow us on your own podcast platform. And of course, we'd love to hear from you.